As I'm sure most of you guys are already well aware of, Sam Bankman-Fried and FTX are going to go down in history as one of, if not the largest and most manipulative fraud schemes the stock market or financial markets as a whole has ever seen. In this rapidly evolving situation of fear really spreading in the crypto markets over the last couple of weeks, you are now seeing a new development, and that is a new apparent filing from the bankruptcy proceedings that are currently going on that shows FTX only has a fraction, not even a fraction, of the total assets under management that they are supposed to have. And this is really not a good thing for crypto, but you also have Binance trying to step in and save the day and essentially do what FTX was doing by bailing out other brokerage firms before they eventually needed a bailout. That's a crazy situation. We're going to talk about it here in this video. But as well as that, you are seeing new reports that the UK is currently in a recession, that the winter shopping, holiday shopping season is not going to be so hot. And if we take a look at the charts of the S&P 500 back during 2008 and 2022, this current year that we are in, they look so similar. You gotta pay attention to it. And it could give us a leading indicator of where the markets might go if we break a key technical pattern, guys. So we got a lot to cover. If you guys didn't get it off the intro of this video, stay tuned, guys. Hit that like button and subscribe to the channel. We will go over everything you guys need to know about all three of these developing situations. So first things first, I do want to start off with the crypto market, because boy, don't you love crypto in 2022. Market cap only dropping about 70%, and a lot of it is and really has nothing to do with crypto itself. The core logic of crypto and what people want for crypto in the future is still very much well intact. It's a confidence issue at this point. If you can't even deposit money into an FTX brokerage account without your funds being stolen from you, then how can you trust any other coin or management of any other coin? You can't. And that's why this situation is so important. And then on the other side of this, there's the contagion effects. Who did FTX get loans from? Because at this point, they're obviously not going to get repaid. And something actually interesting happened with the bankruptcy proceedings. It was ruled that the public will not know who FTX owes money to and how much FTX owes money to. That leads me to believe that there's probably a lot of bad loans out there, likely to a lot of banks, and during this market condition, that's the last thing they want to leak out. So that's a little food for thought. Let me know your tinfoil hat theories down below in the comment section. Who owes what, or who is owed what? Nonetheless, FTT has went from about $26 per share in early November. Now it's trading at $1.50. So it's safe to say a lot of people lost a lot of money in FTX. And that's the real problem here. It's not the coins themselves necessarily. Yes, it is bad when people lose billions of dollars, but as a whole, crypto is much bigger than just one coin, unless you're talking about Bitcoin and Ethereum. I think if either one of those were to, collapse, that would be very bad. Doesn't look like that is very likely as of right now because it's not controlled by really one single entity. Nonetheless, the problem with crypto and actually using crypto as an investment at this point is there is no confidence in crypto at all. You've got all of these second tier brokerage firms in dire straits. The only one that looks like they are okay is Coinbase because they are a publicly traded company, and even that could develop into a pretty scary situation, and that would be a pretty scary situation given how much investing is done in Coinbase. So the contagion here is going to be the big thing that you want to watch for, and that is what could really drive the fear in the crypto markets as well as eventually in the stock market. You guys have seen over the past couple of weeks, some crypto headlines do hit the broad markets, but not every single one of them. This article says, and the new development if in the FTX bankruptcy, that $740 million in crypto assets were recovered from FTX. It says it is being stored in cold storage in, I believe it was South Dakota. They got that shit way far away. I would too if there was that level of fraud going on within the company, but nonetheless, they are saying this is only a fraction of the potential billions of dollars likely missing from FTX's coffers, and that's a big problem. Until we know where that contagion is, I think crypto might perform relatively poorly. On the other hand, guess who is trying to bail out the crypto markets? It's the same people that were beefing with FTX that helped put them in this situation to begin with. It's Binance. They deploy $1 billion to keep crypto industry afloat after FTX's collapse. And it says Binance said it will devote $1 billion in initial commitments to the recovery fund. It may increase that amount to $2 billion at some point in the future if the need arises, the company said. Since FTX's rapid wind down, investors have worried about a crypto contagion affecting every corner of the industry. And like I said, just depending how deep this contagion gets, it could bleed over into the stock market as well, especially when there is going to be different investors potentially getting burned, and they have different stakes in different companies. Would they have to sell their stock? How bad are the banks in on this fraud, right? Those are the questions the crypto community needs to get answers from. Until that happens, like I said, could see some significant weakness in the crypto markets. Now, as far as US shoppers alone, they are boosting Black Friday spending as cost of living crisis hits Europe. Black Friday may offer an opportunity to bag a bargain, but many shoppers will be expecting steeper discounts this year, which this could be seen as a positive thing in the development against inflation, or the fight against inflation, rather, shall I say. But it's nothing definitive or telltale. Goes on to say U.S. consumers are alone in planning to increase their spending this year, while European shoppers expect to cut back by as much as 18%, according to research. The findings come as the global economic outlook darkens, particularly in the UK, which is already in a recession, and Europe more broadly. And this was just declared last week that the UK is already in a recession. The country's independent office for budget responsibility confirmed last week. And a recession is really a bad thing, and we know it's a bad thing. I'm sure you guys have lived through at least one recession, right? I know you have. If you're watching this video, you lived through the brief COVID recession, but a lot of you guys lived through the '08 recession and realized just how bad it started to get before, the bailout started to come. And even after that, it was a really long and rocky road. And fun fact, that about 85% of the time when Europe goes into recession, America will also go into a recession. And even Wells Fargo came out today, their chief global strategist, and said that essentially a US recession might not be that deep, but it could be far reaching to a lot of different sectors of the economy. And that's a big fear of right now. Not only do you have the economy slowing down, but you have the Fed steadfast raising rates, literally pushing us into this recession. And by the time you're in a recession and the Fed realizes, hey, we need to cut rates, we need to stop doing this to the economy, it's already too late 9 out of 10 times, historically speaking, on the front of a recession. So a lot of interesting things right there. It looks like America's not too far behind Europe in terms of a recession. And if that recession comes, stocks are not priced for it. As you guys can see, this is the chart of 2022. You get one peak, well, the final peak in the markets. But after this initial drop, you have seen 1, 2, 3 bear market rallies in 2022. All of these being over 15% piece. Even this last rally that we have seen, we've rallied about 16% over the course of the last couple of weeks, bringing us off of those, sub 350 lows on the S&P 500, but the markets were not crashing because fears of a recession or earnings slowing down. Absolutely not. Indeed, economists have the average S&P 500 earnings going up about 5% next year. Even though about 50% of economists expect a recession, we still expect earnings to grow on the S&P 500 by about 5%. There's something that doesn't make sense there. Now, the fear of a recession is one thing, but once it actually starts to affect company earnings, that is another. So when you look at this chart, this is the '08 chart, and essentially you got the peak of the markets like what we seen in November, which is kind of interesting because the peak in '08 was in October. You've seen one bear market rally, two bear market rallies, and three bear market rallies until you ultimately fell off a cliff and went much, much lower. And I want you guys to really focus on this in particular. I got to put this on a trend line right here. The lows of these bear market rallies. You guys can see all of them. You could put this in here as well. This was before the actual peak, but it was when there was a lot of volatility nonetheless. You got 1, 2, 3, 4 touches to this descending level of support. And then what happened? You got that last bear market rally, in which this is where we are right now if you compare these two charts. And then you broke through that level, and it was a lot of downside after that. From that point of breaking, you fell about 42.5%. That, in theory, let's go ahead and do the same exact thing over again to a current, dated chart of the S&P 500 for what we are currently dealing with. Do these descending level of support lines. Let's call it, if you break this descending line at the 345 mark, your 42% down is, off the charts, guys. It's literally off the charts. I gotta zoom the charts out to actually see what that would cause or where the S&P would go. And you're down here at the $200 mark on the S&P 500. That would be dropping almost 50% from current levels. Now, is that going to happen? What's different about now compared to '08? And what's kind of similar? So what we have seen over the past couple of years has been a lot of fiscal and monetary spending, a lot of artificial boosting of the economy. With those booms, always will come a bust. But it does not look like right now there is a credit crisis. There's not really a lot of people defaulting on loans yet. And a lot of '08 had to do with the banking sector, which is arguably one of the worst, if not the worst, sectors of the economy to fail, because that holds everyone's money. That would be like the government failing, right? If the banks fail, the government basically failed at that point. And you came very close to a full-on government failure based off of 2008. But we're not seeing a credit crisis right now. But what you did see is rapid multiple expansion in a way that we should not have. And the COVID crash low was $210.94. That would be about 50% to the downside from here in the S&P 500. But funny story is, a lot of stocks are already trading at their COVID crash lows. It's really only a couple stocks that have saved the day. Your Apples, your Amazons, your Googles, it was Teslas, Nvidias, these large players that control a vast majority of the markets. Can't leave out Microsoft in that one. They are also helping to save the day. If you start to get those guys that match up with some of these other stocks that are down, at their COVID crash lows, that's where you, in theory, could get a 50% down move, especially if this recession does develop into something that is very big or very bad for the economy, guys. So there is a stark resemblance to 2008 and what we are currently seeing with the S&P 500. This will be and should be the most important level for you guys to keep on your radar. As of right now, it does look like we just broke out of a bullish pattern, and I've had this drawn out for a while now, essentially the peak of this last August rally and this rally back here, and essentially just drawing this line out. You had a clean break above it. It looks bullish for right now, but if you start to see some downside, it could get very aggressive in a very short amount of time, especially if more of that recession talk does start to surface again, guys. So guys, I don't even know what just happened. I think I choked on air, not exactly sure, but I don't want to give you guys that last image from the video, so we're gonna redo it, guys. Hit that like button and subscribe to the channel. Source your comments, questions, or concerns down below in the comment section, and most certainly, if you have made it to the end of this video, subscribe to the channel and hit that like button. It has not yet seen inflation in 2022, even when inflation is at 40-year highs. The like button and the subscribe button have not experienced that. Also, get yourself free stocks. It's literally the easiest thing you could do to earn yourself some free dollar hollers here today. So thank you guys for watching. I will see you in the next one.